Hey everyone, this is Dimitri Pergamonic with MarketChameleon.com. I was going to demonstrate a quick screen using the At the Money option straddle screener, and today we're going to demonstrate how to look for potentially overpriced option straddles. In the option straddle, it's a non-directional play. You're going to be selling the call and the put option simultaneously at the same strike, and it'll be at the money. And here's what the payoff diagram looks like at expiration. So you're selling at the money. Your highest point of profit is if both the call and the put expire worthless, and at the money, and you collect all the premium. As the stock moves further away from it, you start to make less and less until if the stock moves outside the range where you collect for the premium that you collected, then you start losing money. So this is what the payoff diagram looks like in either direction. So let's just come back to the screener, and what we want to do is look for option straddles that are richly priced, that perhaps offer an opportunity to sell some premium and collect that premium income. So over here we see this screener here has both the buys and the sells. So we're going to just look from the sell side, and I'm going to filter that out. And before we filter any further, let's just go over really quickly what the data points mean. And here's the symbol, the stock price, percent change, market cap. This here is the market price if you sold the at the money straddle in Microsoft, the 134 strike in the July 19th expiration. That's the premium you collect, $6.45. And essentially it's saying that your break even is a 4.9% move in either direction, up or down. So you're hoping that by expiration in the next 18 trading days or so, that Microsoft is within 4.9% of the present of this at the money strike. And the question is, well, historically in an 18-day period, how much did this stock move? You know, what is the mean of the absolute return in any direction? If it's 3%, 2%, then this is potentially highly priced, then it could be an opportunity to sell a richly priced straddle. If it's 6%, 7% average move, then you're selling it below the mean, and perhaps this isn't such a good sale, unless there's justifications for either side. And what we're doing here is looking at this theoretical value, which converts the mean move into dollar value. And then you could compare the dollar value of the market price to the theoretical long-term mean. And as you can see here, you'd be selling it in this situation above the long-term mean. And that's why you have a positive edge, because you're selling it for higher than the theoretical value. That gives you a positive theoretical edge. The next question will be, well, how often does the stock end up moving less than 4.9%? What would be your win rate? So if you sold a straddle that requires a 4.9% move to break even, how frequently would have that resulted historically in a profit or a movement of less than 4.9%? So then you do that test, and this is what that win rate is. It's saying 74.4% of the historical data sets tell us that almost 75%, 74.4% of the time that it ended up moving less than 4.9%, which would have resulted in this straddle price being profitable even by a penny. So let's just do a quick screen and screen out for potentially high priced straddles. I'm going to change the years in our analysis using 6 years of historical data. I'm also looking for theoretical edge. So we want a positive theoretical edge. I'm going to put above 10%, meaning that the premium that we receive is at least 10% or higher than the long-term mean, or the theoretical value here. I'm also going to look for a theoretical win rate. Let's put above 80% for now. So this is saying that historically, if we did a similar straddle with the same days to expiration, how it would have to become a winner by expiration 80% of the time or more. That's within the given straddle premium. So now we have we narrowed down our selection here, and let's just go over what came out, and then we'll open up the analysis and look at a study. So the first one, let's go down to here, COTY. We see the price over here. The straddle is $1.30. The theoretical value is 74 cents, so that's a 10% theoretical edge. And historically, this straddle would have produced the profit 84.1% of the time, given this percentage move that it would require. So let's take a look at this study here. And here we know that right now we could receive $1.30 credit for selling the at-the-money straddle in the July 19th expiration 13 strike. The stock price right now is $13.20, a little bit above that strike price. And there's 17 trading days to expiration. So these are all the given variables to us. We also know that in 17 trading days at expiration, if the stock's below or at $11.70, we break even. Anything below it or below 11.3%, we start losing on the straddle. And to the upside, our break even is $14.30 or 18.4% to the upside, because this stock is already a little bit above the strike. That's our break even. Anything above that, we start losing in the straddle, and anything in between these bands, the straddle is profitable because we will collect some of that premium depending where it landed between those strikes. And the question is then, how frequently, historically, how often did it land in between, and when it moved outside, by how much did it move outside, percentage-wise, to the upside or downside? And this is the study here, the theoretical value. We're going to look at 6 years of data for 17-day holding period in the stock. We're going to exclude earnings because there's no earnings expected within this expiration. So we're taking those out of the data set. And we're looking at 63 total observations here. And now we look at the data and we say how frequently in that data set did the stock fall below 11.3% return by the 17 trading days to expiration. That happens 7.9% of the time, and the average value of that would result in $1.80 for this straddle. And here's the data below here with the explanation at each point. Then how many times did it end up above 8.4%? That also happened 7.9% of the time, and the average result of that would have been the straddle being worth $2.09 at expiration. Then what in between this band, 11.3% and 8.4%, that happened 84.1% of the time, which would have resulted for this straddle to being a winner, and the average value is 52 cents. So when you take the long-term mean, 7.9% times $1.80, 84.1% times 52 cents, 7.9% times 2.09, you add them up. If you did this straddle over and over and over again in history, the historical mean is 74 cents. And right now, the premium is $1.30. So that's how you get your theoretical value. And this 84.1%, that's your historical win rate, the amount of times that it landed in between this band with a 17-day trading to expiration. So that's how we get these numbers over here, and it allows you to make a more informed, better decision to quickly assess the situation. Over here to the side, you also have some of the known events coming up that we've already picked up, potentially could make the stock move, and take that into consideration if there's anything here that maybe is justified. There's a company event here, market events. So this gives you a quick view of what potentially can make the stock move, and you might want to take that into consideration when you're looking to sell any type of straddles. Another thing a lot of people tend to do is if they sell the straddle, they might buy the wings and create like a butterfly. And I'll show you an example of that. So for example here, I put up a selling the straddle, and potentially to the upside there's an unlimited amount of risk, because if it keeps going up and up, there's no there's no stopping it here, and this could keep losing until the stock goes to zero. So what you would see is, maybe I'll take a 1 standard deviation move away. You buy the wing over here, you buy the wing over here, then rerun the graph, and then you create like a butterfly where you limit your risk to the upside and downside. Then going back, one thing also to consider when you're selling a straddle, it's really difficult to say, well, what's your return on your investment, because you don't really know what you're risking ahead of time, right? When you're buying a straddle, you know that you're risking the amount of premium that you purchased it for. But when you're selling a straddle, you don't know what your risk is ahead of time. So you could be, potentially risking unlimited amount, but realistically, the stock doesn't go to infinity. So then we created this risk tab to look at historical extremes, stock movements. So over here, we know that here the straddle implied move is 14.9% for this stock. These are your break-even points, upside, downside, and here's you collected 92 cents. And what we do is here, let's shock it, and let's say that the stock moves 10% in either direction. What are you risking? What would your loss be? And here it's 45 cents. What if the stock moved 3 standard deviations? Then your loss would be $3.15. What if the stock made its maximum 1 day move? And historically, we take the max 1 day move, and what if it replicated that move? What would you be risking? And here you would be losing $3.43 to collect 92 cents. And these ratios here are representing how much you are, the ratio of what you're risking to what you potentially can make. So we'll take, this is your risk to the potential what you stand to make. So if you risk $3 to make 92 cents, $3.15, so you're risking 3.4 times as much as you stand to collect in the best case scenario. So here we could also do something like, well, I don't want to risk, let's say, two times the amount of what I stand to make if it's a 10% move. So you do that below 2%, and then that's this column over here. This will narrow down your choices as well. Or I don't want to, you could do, what if it does a 3 standard deviation move? I want to risk, below 3 times what I stand to make. So you could just keep narrowing it down this way, and that's how you narrow down the potential straddles, option straddles from the sell side. Thanks for watching, guys, and hope to see you in the next video.